Chapter 10. Question number 1. Alters Home Center sells renovation and remodeling products to contractors and homeowners. They offer delivery of their products. Not all customers use the delivery, and so ACH adds 10% of the cost of the products purchased to cover the delivery cost. So they charge every customer 10% of their cost as a delivery charge. Looks like total delivery cost was $840,900. Now, it says that one of their employees, an intern, broke down that cost, $840,900, into 3 different activities: picking the orders, delivering the orders, and handling complaints. So it looks like probably the way they did this was they looked at the employees that handled certain tasks. So probably the employees that handled complaints, their salary was $32,400, and then the employees that handled the orders was $522,500, and so on. So they broke down that $840,900 into smaller components. And so with these costs further segregated, they took a look at 2 different customers, Wagner and Burlington. They looked at how much their order value was, and then they looked at how many orders each one made, the total number of items purchased, and the number of complaints. So basically what the company's trying to do is look at each customer more in depth and then try to figure out a more accurate number for how much each customer is costing the company. So for part A, it wants to know what the delivery charge would be for each customer under the 10% calculation. So for part A, it's pretty straightforward. The fact pattern tells us that they just charge 10% of their order value. So for Wagner ordered $12,500 worth of items. Multiply that by 10%, and you get $1,250. And then for Burlington, 13,000 times 10% is 1,300. So for part A, it's 1,250 and 1,300. For part B, it says what would the activity-based costing system estimate as the cost of delivering to each customer. So for this one, we need to calculate the rates for each cost driver. So we can take the fact pattern that they give us. The cost drivers are going to be the number of items, the number of orders, and the number of complaints. And then it gives us the annual cost for each one, and then the annual driver volume. And so we're just going to take the total cost for each one, divide it by the volume to get the rate. So I entered the information from the fact pattern. And then now for the rate, I just do the annual cost divided by the volume, and it gives me the rate. The rate is going to be in dollars. So for number of items, the cost is 80 cents per item. For the orders, it costs $19 per order. And for the number of complaints, it costs $240 per complaint. So those are our rates. And then we will apply those rates to each individual customer. So here I took the information from the fact pattern. The fact pattern says that Wagner Remodeling has 15 orders. They ordered a total of 310 items, and they made 1 complaint. Burlington had 42 orders, so they ordered a lot more. The number of items was only 305, so they ordered about the same as Wagner, but they made a lot more small orders rather than big orders. And then they had 6 complaints instead of just 1. So to figure out their cost, I'm going to take the number of orders for Wagner, 15, multiply that by the rate for orders, which is 19, and I get $285. I do the same for number of items, which would be 310 times 80 cents, and then for number of complaints, and then I total it up, and I get $773 for Wagner Remodeling. Then for Burlington, I'll do the same thing. Number of orders times $19. Number of items times 80 cents. And the number of complaints times 240. And that total is $2,482. So then we just plug in these numbers into question number 1, part B. Remember to plug in the correct numbers in the correct boxes. For picking orders, you're going to put the cost for number of items, and for delivering orders, you're going to put the number of orders. As we can see, Wagner Remodeling and Burlington Contractors, they ordered about the same amount dollar-wise, and the total number of items they ordered were also about the same. But Burlington cost way more to the company because of their multiple small orders, and also they complain a lot more. So whereas a simpler cost accounting system might look at these two customers and consider them fairly equal or fairly similar because they order about this the same number of items and they have the same amount of purchases dollar-wise, we see that if we dive in a little bit deeper into the numbers, that Burlington cost the company a lot more money. So that's question number 1. Question number 2, that's very similar to question number 1, but instead of 3 cost drivers, there's 4. You should be able to still do this one on your own, so I'm going to let you attempt this on your own. Question number 3. Northwestern Bank offers checking accounts. Its customers can write checks and use ATMs. Banks earn money by investing the money deposited, and this bank is no different. So the money that customers deposit, the bank turns around and lends it to other people who need to purchase things like houses or cars or whatever they might need a loan for. It looks like they charge an average of 4.1% annually on its loans, and then they turn around and pay the account holders 0.3% on their deposit. So it looks like a pretty typical bank. They charge more when they're lending out money, and then the interest that they pay to the people who actually deposited the money is going to have to be less so that there's that profit margin. On top of the 0.3% in interest that they pay its account holders, the bank has 4 other costs: using the ATM, visiting the branch, processing transactions, and managing functions. In total, the bank has $18 million in operating costs, plus the 0.3% interest that it pays to its account holders. Now, the bank is looking at 2 customers, Emily and Jacob, and they're trying to figure out how much each of these customers are costing the bank. It says that the average deposit is $10,000. Now, for this question, when they say average deposit, they really mean average balance. So it's not that Emily or Jacob are depositing $10,000 every time they go to deposit money. It's saying that their average balance in their bank account is $10,000. So we'll read it in that sense. So for part A, we're going to compute the operating profit for Northwestern Bank. So as we know, profit is going to be revenues minus expenses. So that's what we have to do here. What is the revenue that the bank earns? Remember that the revenue is when they loan out the money that you put in there as a customer, it'll lend out that money. And then so the bank's revenue is the interest that it makes on the money that it lends out. So in this case, it says that there were $562,500,000 in deposits. And we're going to multiply that by 4.1%, and that's going to be 0.041. And that's how much revenue that the bank gets. So the bank's revenue is $23,062,500. Now remember, the bank is going to pay on the money that it lent out. So we're going to do $562,500,000, and the interest it pays is 0.3%, so that's 0.003. So the bank paid out $1,687,500 in interest to its account holders. The operating costs, we're just going to pull that from the fact pattern. It's $18 million. Our total cost is $19,687,500. And so our operating profit is going to be our revenue minus our costs. And so we have a profit of $3,375,000. So that's our answer for part A. For parts B and C, they want us to calculate how much profit we got from each customer, Emily and Jacob. For part B, we're calculating based on just an overall overhead cost, something we've done in prior chapters. And then for part C, we're breaking down the costs into different activities. So we're going to have to calculate the different rates to use for each cost driver. So for Emily, what is the revenue that we get from her? Remember that she deposited $10,000 on average. So when we take her $10,000 and we loan it out as the bank, we make 4.1% revenue on that. So that's 10,000 times 0.041. We get $410 of revenue from her. And we turn around and we pay her 0.3%. So that's 10,000 times 0.003. And then for operating costs, if we just do the straight rate of 3.2%, which is what the question gives us, that would be the $10,000 deposit times 3.2%. And so her cost would be $320. And so the profit we get from her as a customer is $410 minus the $30 interest we pay to her, minus operating costs of $320. And so the bank profits $60 from having Emily as a customer. What about Jacob? Jacob also deposited $10,000 on average. His revenue will be the same, which is $410. The interest on his deposits is also the same. So instead of recalculating it, I'm just copying the numbers from Emily since those two amounts are going to be exactly the same. And then operating costs is also the same because it's based on deposits. And so that'll be the same thing, $320. And so that means customer profit is also $60. So for part B, the profit from Emily and the profit from Jacob are going to be exactly the same. Now, what about for part C? For part C, instead of using one overhead rate, we're going to break it down like we did in the last question into different activities which are controlled by different cost drivers. So again, I took the information from the fact pattern. They are breaking down the $18 million in cost into 4 different categories: number of uses, number of visits, number of transactions, and total deposits. It also gives us the volume of each of these drivers. And so to calculate the rate, we just take the cost divided by the volume. And so for the first one, using the ATM, there were 300 million instances of ATM use, and so it cost the company 60 cents per use. Number of visits is the cost 1,080,000 divided by 225,000 visits, so that's $4.80 per visit. Number of transactions, $7,920,000 divided by 120 million transactions, and that gives us a rate of 0.66 cents per transaction. And then for total deposits, there's costs for managing this money, so that's $7.2 million divided by total deposits of 562,500,000. And so this gives us a percentage, because whenever you have a division equation and both the numerator and the denominator are the same thing, then they cancel out. So if you're doing $7 million divided by $562 million, then the dollars cancel out. So then the rate is not going to be in dollars. It's going to be, in this case, we're going to do it as a percentage. So that's going to be 1.28%. So now that we have our rates for Part C, we can do a more accurate calculation of customer profit. So for sales revenue for Emily, it's still going to be $410 because that's going to be her $10,000 deposit times the 4.1% of interest that we make off of that. And then we're still going to pay 0.3% on those deposits. So it's 0.003 times $10,000. Number of uses, fact pattern tells us that she used the ATM 40 times. So that's going to be 40 times the rate of 60 cents. She visited the branch 5 times. So that's 5 times $4.80. She had 200 transactions, so 200 times the number of transaction rate. And total deposits is $10,000 times 1.28%. That's $128. So the total cost would be the interest plus the number of uses cost plus the visits plus the number of transactions cost and the total deposit cost. So it gives us total cost of $219.20. So we do the sales revenue of $410 minus the total cost, and that gives us profit from Emily of $190.80. And now we do the same for Jacob. Again, the sales revenue from Jacob is going to be the same, $410, and the interest that we pay him is going to be $30. So those amounts are the same. Now for number of uses, it tells us that he used the ATM 130 times 60 cents, so that's $78. Number of visits, he visited the branch 45 times. He had 520 transactions. And his total deposits is going to be the same, $10,000 times the 1.28%. The total cost here is going to be $486.32. And so revenue of $410 minus cost is going to give us a loss of $76.32. So you compare that to what we did in B. In B, it showed that both customers were profitable, but further analysis in C shows us that we are actually making more profit off of Emily than we originally thought, but Jacob is not profitable. We're actually losing money on him because he's using the ATM quite a bit and he visits the branch quite often. So those interactions are costing the bank more money. So if you look at something like this, maybe you might come to a conclusion that there should be perhaps a limit to how many times a customer might be able to use the ATM or how many times a customer might be able to visit the branch. You know, those are going to be controversial types of decisions to be made, but it's something to think about. Maybe you can have different packages. Maybe you can have a free checking account, which has a certain number of ATMs, and then maybe there's a different checking account that might have a monthly fee if you want to use the ATM more often. And then so we'll just plug in these numbers in Part C. Now, one thing to notice for Part C is that it's asking for total operating cost. So in the Excel spreadsheet, we calculated total costs, but really the question's wanting total operating cost. So that's not going to include interest that we pay to the customers. So we're just going to add up these four amounts for total operating costs. And so for Emily, that's going to be $189.20. And then for Jacob, that's going to be $456.32. So we'll plug those amounts into Part C. Question number 4. Rex Metal Fabricators buy scrap metal from two different places. They buy it from Chopin Yards and Joe Company. It says that we want to have an average quality level of 90%, which means that 90% of the metal must be ready for use without further processing. Metal that needs to be processed further is going to cost us $80 per ton. The question wants us to calculate the effective price for the metal from the two companies when quality is considered. So we look at Chopin. Chopin's price per ton is $124 compared to Joe Company, which is $120. So Chopin is a little bit more expensive, but Chopin, their metal only needs to be further processed 2% of the time, whereas for Joe Company, their metal has to be processed further 7.5% of the time. So both of these companies fall within our 90% range, but we need to figure out what is the effective price for the metal from the two companies. So for Chopin, the price per ton is $124, but then we have to process further 2% of our purchase, and that costs us $80 per ton. So costs for further processing, we're going to do 2% times $80. So on average, we're going to incur another $1.60 in costs. So effective cost per ton is going to be the $124 plus an additional $160 for further processing. So our cost is $125.60. Now for Joe, their price is $120, but their processing is only 7.5% of the time. So we're going to multiply 0.075 times $80. So it's going to cost an extra $6. So our effective cost per ton for Joe is $126. So for part A, the answers are $125.60 for Chopin and $126 for Joe. So it looks like Chopin, even though the price for Chopin is a little bit more, $124, we don't have to process further that much metal. So effectively, it's still a little bit cheaper ultimately. Now for part B, it says, assume all else remains the same. What percentage of metal from Chopin yards that requires further processing would make Rex indifferent? So that means that we need to figure out what the cost will be for Chopin to make it not make a difference to us. So right now for Chopin, 2% of their materials needs to be further processed. But we need to figure out how much more can Chopin go up before it becomes the same as Joe Company. So we need to create an algebraic equation to figure this out. We need to figure out what percentage will be at essentially break-even point. So the equation is $124 sales price plus $80 for further processing times the percentage that needs to be further processed equals the effective cost per ton. So right now the answer is $125.60 for Chopin, right? So it looks like this: 124 plus $80 times 2% equals $125.60. So since the effective cost per ton is less than Joe's effective cost per ton, which is $126, then we're good. But we need to figure out how far up we can go. So that would be 124 plus $80 times P equals 126. So basically what that means is at what percentage will Chopin's cost equal Joe's cost? To do the math, we're going to bring the 124 to the right side. So we're going to be left with 80 times P equals $2, because 126 minus 124 is 2. Then we're going to divide both sides by 80. So that would be P equals 2 divided by 80. So P equals 2.5%. So as long as Chopin's percentage is at 2.5% or less, then we can still stay with Chopin. Now, once it reaches 2.5%, then it would yield the same results, and if it exceeds 2.5%, then Joe Company will be the cheaper option. So that's number 4 and 5. Question number 6. This question, Ellery Products is buying fabric from 2 different vendors, Ewers and Bramford. We need to buy 800 yards of fabric, and we need to figure out who to buy it from. Ewers is bidding $2,261 for those 800 yards, and Bramford is bidding $2,134. So Bramford's price is a little bit lower. But we also have to consider how much of their fabric is good fabric. So the question tells us that in the past, we've purchased 19,800 yards from Ewers. We had to throw away 990 yards of that because it wasn't usable. For Bramford, we've purchased twice as many, 36,900, but we've had to throw away a ton more. We've had to throw away 4,428 yards of their fabric. So it looks like Bramford, we're throwing away percentage-wise a lot more than we throw away of Ewers. Let's see exactly how much we throw away. So for Ewers, we had to throw away 990 out of 19,800. So we threw away 5%. For Bramford, we're throwing away 4,428 yards out of 36,900. So for Bramford, we're throwing away 12%. So we throw away a lot more Bramford. But Bramford is a little bit cheaper, $2,134 compared to $2,261 for Ewers. So which one do we go with? So to figure this out, we have to do the math. For Ewers, it's $2,261 for the 800 units, right? But the 800 units we can't use. The 800 yards of fabric, we can't use that all because some of it, 5% of that, is wasted. So we don't get to use 100% of the yards of fabric that we purchase. We can only use 95%. So we're going to divide that by 0.95. So that means that effectively the cost for the 800 yards is $2,380. And for Bramford, theirs is $2,134. But again, we're not going to use 100% of those 800 yards of fabric. We're going to have to reduce it by 12%. So instead of 100%, we're only going to get to use 1 minus 0.12, or 12%. So that's only 88%. So 2134 divided by the 88% equals 2425. So those are your 2 answers for part A. And then part B just asks, which supplier would you recommend that the purchasing manager select? Well, you just look at which supplier is cheaper, effectively, and that would be Ewers. So even though Ewers quoted you a higher price of $22.61, their materials is better quality and you don't have to discard as much of it. So effectively, it's cheaper. For question 7, it says, what bid by Ewers would make Ellery indifferent between buying from Ewers or Bramford? So the way the equation looks right now is that the quoted price of $22.61 divided by 95% equals the effective cost per ton of $23.80. Now we're trying to figure out what if the effective cost per ton equals the price for Bramford. So we would do X divided by 95% equals 24.25, which is the effective cost per ton for Bramford. So to figure this out, we do 24.25 times 95%, and that gives us a quoted price of $23.03 and 75 cents. So Ewers is quoting us $22.61. They can go all the way up to $23.03 and 75 cents. And at that point, it wouldn't make a difference whether we pick one or the other vendor. But anything higher than $23.03 and 75 cents, it would be better to go with Bramford rather than Ewers. Question number 8. I'm going to let you guys do this one. You're just comparing resources used to resources supplied. They give you the figures for resources supplied, and you compare that to resources used by multiplying the cost driver rate by the cost driver volume, and you find the difference between the two, and that's going to be your unused resource capacity. That's going to be how you do number 8. Question number 9, that follows the same fact pattern as number 8, so I'll let you do this one also. In this one, you're preparing a traditional income statement and an activity-based income statement. So for the traditional income statement, for operation costs and maintenance costs, you're going to use the amounts that they gave you for resources supplied, because those are costs that you actually incurred. And then for the activity-based income statement, you're still going to use those two amounts, the 18,000 and the 2,700. Those are going to be your totals, and then you're going to split up those totals between resources used and unused, and that's what you calculated in question number 8. A good example of these two types of income statements are going to be on pages 459 and 460 of your textbook. Questions 10 and 11 are going to be similar to questions 8 and 9, so I'll let you do these on your own as well. Question 12. This question deals with excess capacity and how to allocate it. In this question, Middle Industries produces a sensor for use in manufacturing. The plant has an annual practical capacity of 75,000 units. Practical capacity means that if it's 75,000 units, actual capacity could be higher than 75,000. Probably the plant could produce 85,000, 90,000. But practically, when you consider machine breakdowns and maintenance and other factors, the practical capacity is 75,000. The question tells us that the variable cost is $185 per unit, and the fixed costs of the plant are $12,375,000 annually. Current annual demand is 55,000 sensors. So we can produce more than 75,000. Practically, we only produce 75,000, but demand-wise, they only want 55,000. So we have excess capacity. Middle Industries bought the plant because it's closer to its other manufacturing facilities and was available for sale when they were searching for a location. So what does it matter that the reason that the plant was purchased was because it was closer to other manufacturing facilities? It matters because that determines how we allocate the excess capacity costs. So in this case, Middle Industries bought the plant because it was convenient to Middle Industries. They didn't do it for a customer. They didn't do it to please other customers. They did it for their own benefit. This is in comparison to situations where excess capacity is purchased because of custom. Now, the book gives an example of the airline industry. We know that in the airline industry, there are seasons. The summer season is very busy, and also during holidays, there's a lot of demand for flights. The demand for those flights are going to be much higher in those seasons that we just mentioned than throughout the regular year. But to be able to meet the demand during those high peak periods, airlines are going to have enough airplanes available during those peak periods. Now, whenever the busy season is over and it's just regular demand throughout the year, then those planes are going to sit idle. But the reason why we have extra airplanes during the slow season is so we can meet customer demand in the busy season. So in that case, excess capacity costs are for the benefit of the customer. And so those costs are going to be allocated towards current production because they were incurred for the benefit of the customers. So again, we compare that to this situation where excess capacity was purchased for the benefit of the company, not necessarily for the benefit of the customers. So part A says, what cost per sensor should the cost system report to facilitate management decision making? So in this case, again, since the plant was purchased for the convenience of Middle Industries, then the excess capacity shouldn't be charged against current production. And so the $12,375,000 of fixed costs are going to be spread over the 75,000 units, which is the practical capacity, not just concentrated on the 55,000. So for part A, we're going to do 12,375,000. Divide that by 75,000 sensors, which was the practical capacity, and we get $165 per unit. And then we add the $185 variable cost that was given to us in the fact pattern. And so for A, we get a cost per sensor of $350 per unit. For part B, it says, what is the cost of excess capacity? So that's going to be our $12,375,000 fixed cost minus the cost of the 55,000 sensors that we did produce. And so that's going to be $165, which is the allocated fixed capacity cost that we calculated in A, times the 55,000 sensors. And that gives us $3,300,000. That's going to be our cost of excess capacity. And then part C, it says, what cost per sensor would the cost system report if the smallest manufacturing plant that could be built was 75,000 sensors? So instead of purchasing a plant that's close to us and that was convenient for us, we are building a plant, and we're building a plant that can produce 75,000 sensors. So what that means is, even though we have only demand of 55,000 sensors, the building contractor said, no, sorry, we can't build a plant for just 55,000 sensors. We have to build a plant that's a certain size, and that's going to be able to produce 75,000 sensors. So that means that in this situation, in part C, we have 75,000 of capacity when we only need 55,000. And that excess capacity is not something that we necessarily want. It's just what we had to get. And so in that case, this is considered capacity for the customer's benefit, because the customers want 55,000 sensors. we're trying to give them just 55,000, but the building contractor, is making us build a plant that can produce 75,000. So that's not our decision. That's not our fault. So we're going to charge that extra 20,000 excess capacity to the customers. So now to calculate cost per sensor, so we're going to do 185 for the variable cost of the sensor. And then for the fixed capacity cost, we're going to do the 12,375,000. But instead of dividing over the 75,000 sensors, which is the practical capacity, we're going to divide it among the 55,000 sensors, which is the actual current demand for the sensors. And so what that does is it spreads the cost over those 55,000. Since the excess capacity is for the customer's benefit, then the customers have to absorb all those costs. So it's going to be the 185 plus the 225, and that gives us $410 for the cost for part C. Question number 13. It's very similar to question 12. In question 13, Basil's Framing manufactures picture frames. Their plant has a practical capacity of 40,000 frames. Again, that means that the plant can actually make more frames, like let's say 45,000, 50,000 under ideal conditions. But for practical purposes, when you consider maintenance of machinery, breakdowns, the practical capacity is going to be 40,000. The variable cost is $24 per unit, and the fixed costs are $392,000 annually. Current annual demand is 28,000 frames. So practically we can make 40,000 frames, but current demand is 28,000. So we have an excess capacity of 12,000 frames. It says that Basil's Framing bought the current workshop because of forecasts that demand for the frames would grow. So again, we're doing this not for the benefit of the current customers. We have excess capacity because we believe that our business is going to grow in the future, our demand is going to grow, and so we want to be ready for that. So even though this is a benefit for possible future customers, this is not a benefit for current customers. And so we're going to allocate those costs for excess capacity to the period and not to those customers. So for part A, it says, what cost per frame should the cost system report to facilitate management decision making? Well, it tells us that our variable cost is $24. And for our fixed capacity cost, it's $392,000. We're going to divide that by the 40,000 frames because we don't want to just divide it among 28,000 frames because those are what the customers are purchasing. If we divide it based on just those 28,000 frames, which is the current annual demand, then all of the excess capacity costs are absorbed into those 28,000 frames, which isn't really fair. It doesn't give an accurate picture for those customers buying those 28,000 frames. Because again, if we're going to allocate excess capacity costs to those current customers, it has to be because those current customers are going to benefit from the excess capacity. In this case, the excess capacity is not for the benefit of those current customers. The 392,000 divided by the 40,000 frames is $9.80. And so the cost of that is $33.80. For part B, what is the cost of excess capacity? Well, the cost of excess capacity is going to be the $392,000 minus the 28,000 frames that we did create times the $9.80 cost. And so that leaves us with $117,600. as costs for the excess capacity. For part C, it says what cost per frame would the cost system report if the smallest manufacturing plant that could be built was 35,000 frames. For part C, the answer seems to be inconsistent with the prior question. The answer to C is $35.20 for the cost per frame, and they're dividing the 392,000 in fixed cost by the 35,000 frames. So that's in contrast to the prior question where they divided the fixed cost by the number of units demanded, not the practical capacity. So for this one, just put $35.20 as the cost per frame and the excess capacity cost as $78,400. So you can get the full points for this question. Questions number 14 and 15, I believe you guys can work those on your own, so I'm not going to work them. And that's it for the Chapter 10 homework.